All right, let's talk about Cello World. It's a name you see everywhere, right? But their latest financial report has got a lot of people scratching their heads. So today, we're going to dig into their third quarter results and figure out exactly why a company with pretty steady sales is suddenly watching its profits just nosedive.
So this is the big, blinking number that really jumped out from their latest report, 26%. That's how much their net profit dropped compared to the same time last year. And look, that's not just some tiny dip, that's a serious slide, and it's definitely got the market paying attention. So let's unpack what's really going on behind this figure.
Okay, to really get why that profit number fell so hard, you have to look at the whole picture. So check this out. Their revenue, the total cash coming in the door, was almost exactly the same as last year, down just 1%. But then you look a little further down the line at EBITDA, that's kind of their core profit from operations, and boom, that fell by 12%. This is the key clue, right? The problem isn't that they're selling less stuff, it's that they're making way less money on every single thing they sell.
All right, so here's how we're going to break it all down. We'll start with that profit plunge, then look at their 3 different business divisions, what's happening with their profit margins, what management has to say, and finally, Cello's big bet on glassware.
Okay, let's jump right in. First up, let's get a better look at this profit plunge.
Sometimes seeing it laid out like this really drives the point home. It's so stark, right? Last year, in this same quarter, Cello pulled in over 86 crore in profit. This year, it's down to less than 64 crore. We're not just talking percentages anymore. That is a huge drop in actual money. And that brings us right back to the central mystery here. If you're selling basically the same amount of products, where on earth did all that profit go? It's a great question. And the answer, well, it's not about how much they sold. It's all about what they sold and how much it cost them to make it. So the answer to that question, it's hidden inside the company itself, in how its 3 main business areas performed. And it was a real mixed bag. It's almost like an internal tug-of-war, with each division pulling in a completely different direction.
Now, to really understand what's going on inside Cello, you first have to see how the company is built. Just look at this. Their consumerware division is the absolute engine of the company. It's bringing in over 70% of all their revenue. So you can imagine, if anything goes wrong in that one huge part of the business, it's going to shake the entire company.
Okay, let's start with some good news, because there was some. Their writing instruments division, we're talking pens, stationery, all that stuff, was actually a real bright spot. It grew by a pretty healthy 11% compared to last year. So that's good.
But, and this is a big but, that giant consumerware division, their absolute core business, ran into some major trouble. Performance was pretty flat, and the company was really clear about why. They had problems getting enough steel, and you can see how that would hit things like their insulated flasks and all that popular cookware.
And then we have the molded furniture part of the business, which really acted like an anchor, just dragging down the overall performance. And what's interesting here is that their revenue actually went down, not because they sold fewer chairs, but because prices for furniture across the whole market were falling, and that just eats directly into your bottom line.
So you put all that together, right? One part of the business is doing well. The biggest part has supply problems, and another part is dealing with falling prices. What you get is something called margin compression. It sounds technical, but it's simple. The space between what it costs Cello to make something and what they can sell it for is getting smaller and smaller. They're getting squeezed.
And wow, this slide right here shows you that squeeze in black and white. It's really clear. A year ago, for every 100 rupees of stuff Cello sold, they got to keep about 15.5 rupees as pure profit. Fast forward to this quarter, and that number is down to just 11.5 rupees. That might not sound like much, but that 4-point drop is massive. That's exactly where all those millions in profit just disappeared.
So, okay, things are tough. What does the leadership team have to say about all this? And even more important, what's the game plan to fix it? Let's get the view from the corner office.
So the chairman, Mr. Rathod, he was pretty straight up about it. He basically said, look, the holiday season sales were actually pretty good, but overall, customer demand has been, well, all over the place. What that tells us is that they're dealing with a really tricky, unpredictable market right now. So to fight back against all this, management has laid out a 3-step plan. First, they're going to streamline their product lineup to be more efficient. Second, they're going to push more of their high-end premium stuff, which, has better profit margins. And third, they're going to refocus their sales strategy on new channels, especially online. Honestly, it's a pretty classic game plan when a company finds itself in a spot like this.
But it's not just about these immediate fixes. Cello is also making a huge long-term bet that they hope will be a total game changer. This is them trying to switch from playing defense to playing offense.
So that begs the question, what is the long-term plan here? How do you get past a rough quarter like this and start building for the future? Well, for Cello, the answer seems to come down to one word: manufacturing.
Yeah, Cello's long-term strategy is all about taking back control. They're pouring a ton of money into building their own manufacturing plants, especially this brand new facility in Rajasthan that's going to focus on glassware and steel. And you can see this is a direct answer to those steel supply problems that hurt them so bad this quarter.
So here's why this is such a big deal. This new plant is designed to give Cello a massive advantage. I mean, think about it. They're on track to become the only big company in the country making their own glassware in-house. That means they can stop relying so much on imports. They're also bringing in top-of-the-line European machinery, so they're betting on making really high-quality, well-designed products. It's all about controlling their own destiny.
And that really leaves us with the big final question. Right now, Cello's definitely fighting through some serious short-term problems. But this huge investment, this big glassware gambit, it has the potential to completely change the game for them. So the question is, will this massive long-term bet pay off? Will it be enough to get them through the current storm and kickstart a whole new chapter of growth? I guess we'll just have to wait and see.
Okay, let's start with a mental image. I want you to picture a crime scene. But we aren't talking about yellow tape or chalk outlines. We are looking at a stock chart.
Not just any stock chart.
No, specifically the daily chart for Cello on the National Stock Exchange. And it's dark, it's moody, and frankly, there's a whole lot of red ink spilled everywhere.
It's a dramatic chart for sure. And, crime scene isn't too far off if you happen to be a bullish investor who's been holding this stock since, say, last November.
Right.
We're looking at a technical breakdown that has been months in the making, and it's all culminating in some very aggressive price action right here in mid-February.
Exactly. For everyone listening, we aren't just looking at random wiggles on a screen. This is the daily candlestick chart for Cello, World Limited ticker Cello on the NSE. And the headline number staring us in the face today is 468.05.
But that number is just the end of the story, isn't it?
It's just the final timestamp. The mission for this deep dive isn't just to say, hey, the stock went down. I mean, anyone can see that. We need to decode the quality of this move.
Right. We need to understand the intent behind the price. Because when you look at a chart like this, you're not just seeing algorithms fighting. You're seeing the collective psychology of thousands of people making decisions with real money.
And right now, that decision seems to be a resounding get me out. So let's set the scene visually for you. We're looking at a standard daily chart, dark background. We've got the price shown by red and green candlesticks. And then there are these green lines, the Bollinger Bands, sort of wrapping around the price.
Like Riverbank. Yeah.
And down at the bottom, there's a volume panel that looks a bit like a city skyline. And in the middle, that white squiggly line of the RSI.
Standard tools, really. But the story they're telling together is anything but standard right now. It's a convergence of signals.
Okay, so to understand the gravity of where we are at 468, we have to rewind the tape. We need to go back to the, quote,
please like
good
and
old
subscribe
days of early November.
That context is vital.
If I look at the top left of the axis, the price scale actually tops out at 633.50s. Back then, Cello was trading comfortably in that 600s range. It was the peak of the mountain.
And you can't judge the current price in a vacuum, right? A 468 price tag feels very different if you just fell from 470 versus falling from over 630. We're talking about a significant chunk of market cap just gone.
I'm tracing the price action from November through December with my finger, and it's textbook, isn't it? It looks like a staircase going down into a dark basement.
It is the classic definition of a downtrend. Technical analysis 101, lower highs and lower lows. If you look closely at those candles, every time the stock tried to rally.
Every little green candle cluster.
Yeah. Every time it failed to reach the previous peak.
It just runs out of breath every time it tries to stand up.
Exactly. The buyers step in, they push it up a few rupees, but the sellers are just waiting at a lower level than before to smack it right back down. And when it falls, it breaks the previous floor.
That structure, lower highs, lower lows, that's the heartbeat of a bear market. It's like a ball bouncing down the stairs. Gravity is winning.
And that continued all the way into early January. But then the plot thickens a bit. We hit late January and the chart's character changes.
Right. This is the part that traps a lot of traders. This is the danger zone for bargain hunters.
Totally.
I see it. The staircase stops. From late January into early February, the price action just flattens out. We stop making those lower lows. We see a mix of green and red just hovering right around that 500 to 510 mark. It looks stable.
That's what we call a consolidation phase. And in technical analysis, this is a critical battleground. The sellers are maybe a little exhausted from pushing it all the way down from 600.
And buyers are stepping in thinking,
Well, they're thinking, okay, 500 is a nice round number. It's a psychological floor. Maybe this is a bargain.
the anchor effect. People see 600 in the rearview mirror, they see 500 on the screen, and their brain tells them it's cheap because they're anchoring to that old high price.
Precisely. The market is just taking a breath. And in that moment, it's a coin flip. Consolidation can be a base, a foundation for a recovery, or it can be a continuation pattern.
Which is just a pause before the next plunge.
Exactly. The market is deciding if the price is fair or if there's more pain to come.
And unfortunately for the Cello shareholders, we got our answer in mid-February. The coin landed, and it wasn't heads.
No, it was not.
Okay.
The chart gives us a very clear, very harsh verdict.
Yeah.
We had the mid-month results declaration around February 14th, Valentine's Day of all things, and the market's reaction was just brutal.
Yeah, no love lost there. Let's zoom in on this main event. We are focusing on the price action immediately after those results, specifically the trading around February 17th.
Yes.
The chart shows a massive red candle falling right off that consolidation shelf. It didn't just drift lower, it snapped that 500 rupee support level like a twig.
That is a high conviction move. You have to understand, when you spend weeks building a floor at 500, a lot of people put their stop losses just below it. So when the price slices through it in one session, it triggers a cascade of selling. It just destroys the thesis for every bull who bought in January thinking they caught the bottom.
I want to get really granular here because the specific numbers of this latest candle tell a mini story of their own. I'm looking at the data box in the top left. We have an open of 475.0,
Okay.
a high of 477.45, a low of 467.15, and a close of 468.05.
Those four numbers are like a forensic report of the trading day. Let's peel them back. Start with the open. 475.0.
That's already a gap down, isn't it? The previous days were higher, so before the bell even rings, the sentiment has already soured.
Right. A gap down is a sign of overnight urgency. It means sell orders were piling up before the market even opened. But then look at the high, 477.45.
It's only about 2 rupees higher than the open. That's pathetic.
It's incredibly weak. Think about what that represents. The market opened, it was already down, and for a brief, fleeting moment, some buyers tried to step in.
They tried to fill the gap.
Yes, and they could only push the price up by what, roughly 2 rupees? That's nothing.
And then they got crushed.
Immediately. The sellers just slammed the door. There was zero conviction on the buy side. The bears owned the market from the first 5 minutes.
And they owned it until the last minute. We hit a low of 467.15.
Yeah.
And the close was 468.05. That's a difference of just 90 pays.
That, for me, is the most bearish signal on the entire chart.
Walk us through that. Why does the proximity of the close to the low matter so much? I mean, a low close is bad, but why is this so bad?
In a healthy market, or even one that's just confused, you often see a wick or a shadow at the bottom of the candle.
Okay.
That happens when the price drops. But then value investors or shorts covering their positions step in late in the day to buy, pushing the price back up a bit before the close. It shows resilience.
It shows someone thinks the low price was too good to pass up.
Exactly. But we don't see that here. We see a solid red body with almost no bottom wick. This is what you might call a variation of a Maribozu candle. It means sellers were aggressive right up until the final bell.
So at 3:29 in the afternoon, people were still hitting the sell button at the lowest price of the day. They didn't care about getting a better price. They just wanted out.
They were escaping the building. That implies panic. And more importantly, it implies the selling pressure hasn't been exhausted. If nobody stepped in to buy at 467 today, who's to say they will tomorrow?
That's a sobering thought, but I want to play devil's advocate. Price can be manipulated, right? How do we know this isn't just a few nervous retail traders?
You're looking for the truth serum. We need to talk about volume.
I am. I'm looking at the bottom panel. During that consolidation phase in January, that waiting room period, the vertical volume bars were pretty short. It was quiet.
Which is normal. Indecision usually happens on low volume.
Yeah.
Everyone's waiting for a catalyst.
But then, look at the far right. Boom! There's a massive red spike in volume corresponding with this price drop around the 16th and 17th. It's one of the highest volume bars on the chart.
That spike is the confirmation. In technical analysis, we have a golden rule. Volume validates price. If the price dropped 5% on low volume, you could argue it was a fluke.
Maybe a lack of liquidity or something.
But a price drop on high volume, that is institutional. That's the big money moving.
It has to be. Retail traders usually can't generate that kind of volume spike on their own.
No. It suggests a significant amount of supply is hitting the market. It tells us this breakdown isn't a drift, it's a liquidation. Large holders are exiting, and they're doing it with conviction.
So, connecting the dots, the results come out mid-month, the market digests them, and the verdict is a high-volume sell-off that breaks support. It's not a wait and see anymore, it's a sell and run.
The chart is shouting that the downward move has energy behind it. It's accelerating, not running out of steam. That volume bar is like the engine revving up on the decline.
That sounds ominous. But let's look for other clues. Maybe there's a safety net we're missing. I want to talk about volatility. We have the Bollinger Bands here.
The green lines, yeah.
The riverbanks. I know the basic theory. They represent standard deviations. Usually, price stays inside them.
Correct. They give us a statistical envelope for where the price should be.
So what are they telling us right now about Cello? Because looking at the chart, the red candles are literally sitting on top of the lower green line. They're just pushing it down.
We call that walking the bands. It's a very distinct, very bearish behavior. In a normal range-bound market, if the price hits the lower band, it usually bounces back toward the middle.
Like hitting a rubber wall.
Right. But here, the wall isn't bouncing back. The selling pressure is so strong that it's actually warping the statistical envelope. The price is hugging that lower deviation line and riding it down.
It indicates extreme weakness.
Extreme. It means the stock is essentially trading at the statistical floor of its range every single day and finding no buyers to push it back up.
And look at the shape of the bands. Back in January, during the quiet phase, the upper and lower lines were getting closer together.
That was the squeeze. Low volatility. That usually precedes a big move.
And we got the big move. Now, the bands are flaring wide open. The mouth of the river is getting wider.
That's an expansion of volatility. And since the price is breaking down, this expansion suggests we are entering a new trending phase. The quiet period is over, and momentum has shifted violently to the bears.
Okay, so price is dropping, volume is spiking, and the Bollinger Bands are screaming downside volatility. Is there any glimmer of hope here? Let's look at the RSI in the middle panel.
The momentum gauge, the relative strength index.
Right. It's trending down, obviously. It looks like it's getting close to that 30 mark. Now, I know the textbook says RSI below 30 means oversold, and oversold sounds like undervalued. Does this mean we're due for a bounce?
You know, if I had $1 for every trader who lost money buying purely because RSI was oversold, I'd be retired on a yacht.
So it's a trap.
It could be a huge trap. Oversold works great in a sideways, choppy market. But in a strong trend, an indicator can stay oversold for weeks.
The gauge can just stay pinned in the red zone.
Exactly.
Yeah.
Think of it like a car driving down a steep mountain. The speedometer might say you're going dangerously fast over speeding, but that doesn't mean you're about to stop. It just confirms you're barreling downhill.
That's a great analogy. Just because the needle is buried doesn't mean the car is about to run out of gas.
And the RSI pointing down here simply confirms the momentum is negative. What we'd look for as a sign of hope is divergence, where the price makes a new low, but the RSI makes a higher low. That shows the sellers are getting tired.
But looking at this, price is making a new low and RSI is making a new low.
They're in perfect agreement. There's no divergence. The sellers aren't tired. They're just getting started.
So let's synthesize this. We have a stock that was trading near 633 in November. It's stair-stepped down. It gave investors a fake out in January by going sideways. And then, triggered by those mid-February results, we see a high-volume capitulation down to 468.
That's the narrative. And the key takeaway here is the destruction of that structure. That 500 level was a psychological floor. Once that broke, every single person who bought in January is now underwater.
Meaning their position is showing a loss.
Right. And human psychology being what it is, when people are underwater and see the price tanking on high volume, they tend to panic sell. This creates more supply, which drives the price down further. It's a feedback loop.
A vicious cycle. And looking at this chart, where is the next floor? We are at 468. Do we have historical support below this?
That's the scary part. When you're making lows for this period, you're in price discovery mode. There is no recent history below us to say, oh, it bounced here last year. The market is groping in the dark.
Price discovery sounds adventurous, but in this context, it just sounds like free falling until you hit a ledge you didn't know was there.
It is. Catching a falling knife is dangerous. Professional traders looking at this would say, I need to see stability first.
Yeah.
We simply don't see any of that yet.
So for the listener watching this stock, the message from the chart is clear. The trend is your friend, and right now the trend is your enemy if you're long.
The trend is unequivocally down. The technical damage done on February 16th and 17th is significant. To repair this, the stock would need to climb back above that 500 level turn, that old floor back into a floor, to prove this was all a bear trap. Until then, the bears are in the driver's seat.
I want to circle back one last time to that final candle, the 468.05 close. We talked about the lack of a wick. What does that usually predict for the next trading session?
Well, momentum has inertia. If everyone is selling at the close, there's usually a backlog of sell orders, so you often see immediate pressure the next morning. A close at the low technically predicts continued weakness at the next open.
It's amazing how much story is packed into a single image. We've got the macro slide, the false hope, and the brutal reality of the volume spike.
And that's the power of technical analysis. It strips away the noise. We're looking at what people are actually doing with their money. And right now, the vote count is overwhelmingly sell.
Well, we certainly unpacked a lot today. From the heights of November to the lows of February, it's a cautionary tale about respecting the trend.
And understanding that you never, ever ignore the volume. It's the only part of the chart that can't be faked.
Absolutely. So we've analyzed the slide, the volume, the bands, and the RSI. We've seen Cello break support and close weak.
A textbook bearish breakdown in every sense of the word.
Before we wrap up, I want to leave you with a thought. We talk about market efficiency, but markets are made of people. When you look at a chart like this, where the closing price is almost exactly at the day's low, 468.05 close against a 467.15 low, is the market signaling total capitulation?
You mean, has everyone who wanted to sell finally sold?
Yeah. Is the selling over?
Or is this simply the momentum building for the next leg down? Is this a sign that the elevator cable has just snapped?
That is the question every trader faces at the hard right edge of the chart.
And the answer usually costs money to find out.
Thanks for diving deep with us today. Keep your eyes on the charts, watch that 500 level, and we'll catch you on the next one.